Thank you so much to our panelists for being here this afternoon. We don't take it for granted. And yeah, I'd like to just get going with really just understanding why financial literacy is very important for young people. So maybe I can direct my first question to Ibi. I'd like to ask you, what do you feel are the biggest money mistakes young adults make, and why is financial literacy important?
Okay, hi, okay, thank you. And thank you for having me here. Congratulations.
Thank you so much.
So in terms of the biggest mistakes that young people make, the first one is spending money before you have it. So I don't know if you or anybody here has ever experienced this where, you know that you're about to get a payment or you have some money coming in. So let's say it's like Friday and it's about to be the weekend. And you want to do your hair or you're going out with your friends and you know that, okay, I'm getting some money on Monday, so let me just spend the money today, I'll get it. And then surprise, surprise, Monday comes and then there was a delay or something happens and then you're stuck and you're scrambling. So I'll say that that's the number one big money mistake, is just spending money like before you have it. Never ever spend money that is not in your account. No matter who promised you or how trustworthy they are, if it's not in your account, you technically don't have it. The second biggest money mistake is thinking that you should wait until you have a lump sum of money or you make some kind of big money before you start taking your money seriously. Because I know that when you're a student and you don't necessarily have an income, or it's just like small amounts you're getting here and there, saving or investing whatever you can you might even feel silly doing it. Like, this amount is so small. What could this ever possibly amount to? The truth is that the discipline that you have with 50,000 naira is the discipline that will meet you with 5 million naira. As ridiculous as you feel saving 1,000 naira or 500 naira, do it. You need to build your habits early, because it's like building a house. Whatever infrastructure you have now is what's going to carry your home. So just make sure that you do it. Don't wait and think that, okay, when I get my first big girl job or my first big girl salary or big boy job, that's when I'll start saving. That's when I can think about investments. Try with whatever little you have. Then I would say the last thing, especially for students, is not investing in yourself. Because at this point, your earning is not, I would say, in the top 1% of Nigerians. You're just starting out your career and your own independence and your lives. Investing in yourself is the best thing that you should do. So don't avoid investing in yourself. So investing in yourself is coming to events like this, meeting people, talking to people who have walked the path ahead of you, investing in your skills, investing in your appearance, in the way that you come across. It is so important because it sets the foundation to how much you can make in the future. And in terms of why financial literacy is important, what you don't know, you can't grow. So if you don't know money, how are you going to get better?
Very true. Thank you so much for sharing that. And I'm really glad that you talked on investing in oneself, and then obviously also not being afraid to start saving and investing even with the little you have. So on that note, I'd like to direct my next questions to Ms. Onyinye and Mrs. Oghogho. Could you please talk to us about what both your organizations do in terms of how people can start investing or start saving in that aspect? Yeah. Who would like to go first? Yeah. Okay, Ms. Onyinye, thank you.
All right. Good evening, everyone. Thank you, Oge, for having me here. It's a pleasure. So I work at United Capital PLC. We're a Pan-African investment firm. We have 8 businesses, so essentially there is a product for everybody. I know that we're all youth starting out, so let's not be timid or think that, when you hear the United Capital Investment Firm, you might just think, okay, you know what, I don't have the kind of money that they need. No, that's not it. So we have an asset management firm, and we have a lot of mutual funds there for retail investors up to HNIs and corporates. We have wealth management firm, trustees. Trustees essentially is just putting a will in place for your beneficiaries in your lifetime or after you have passed away. We have an investment banking firm that deals largely with corporates, project finance, capital raising, debt equities, equity financing. We also have a microfinance bank. We have a consumer lending business. We have a Pan-African investment firm as well. And essentially, United Capital just is a one-stop financial workshop. So we also have a consumer lending business, which also offers loans to the public. So if any type of investment that you want to do, we can do that for you, help you create your wealth, preserve your wealth for the next generations. Thank you.
Thank you. Thank you very much.
Thank you very much. It's a pleasure to be here. It's a pleasure to be part of the people who are supporting this. Emerging Africa Group is an impact-based financial services Mongol, that deals in innovative solutions to capital raising, to investment banking, to asset management, to infrastructure finance, as well as technology. So we have multiple subsidiaries. We have an asset management company, just like UCAP. We have an investment banking arm. We have an infrastructure development special purpose vehicle through which we develop infrastructure in the States. We have a microfinance bank. We have a technology company called Fund All. We have also a capacity building firm. So how can you, as the youth of Africa, take advantage of dealing and investing? We have an asset management company that has several mutual funds. There's a mutual fund for Eurobonds, there's a mutual fund for money market funds, there's a mutual fund for balanced diversity, and there's also a mutual fund for, religious halal kind of, funding. So with as little as 5,000 on a monthly basis, it's never too early to save and invest. It's like an esusu kind of arrangement where ordinarily you don't have enough to make a big investment, but then you pull the funds together in a mutual fund and it gives you access to what ordinarily you wouldn't be able to access by yourself. So when you start small, you can easily deploy it over a long term and build wealth that will be sustainable. So that's my advice.
Thank you. A round of applause, please. Thank you so much. And I love that we're talking about how, what both organizations do in terms of investing and saving. And I'd like to ask, I'll bring this to Ibi and Onyinye, please. I want to ask about what would you say is the difference between saving and investing, and realistically, how can young people create and stick to a budget? And I think I'd also like to ask if Ibi can speak more about MoneyStart. Obviously, she's the founder and lead financial advisor. So if you can, we can start with you. If you can talk about what MoneyStart does, and then, just speaking to the question of what's the difference between saving and investing, and how can young people try and stick more to being able to do that? Yeah.
Okay, sure. So I'm the CEO of MoneyStart, and as the name implies, it's for you to get started with your money. So we're a financial education and financial planning firm. Fun fact, when I actually started MoneyStart, you guys are my target market. So it was supposed to be for people who are just starting out in their careers, getting paid your first salary, first taste of independence, and just building those finances as you're growing in your lives. I was quite surprised when people in their 30s and 40s started calling, which was a great surprise. So that's the name of MoneyStart. So it is a financial education company to help you grow your wealth and continue to grow your wealth when you do have wealth. So in terms of the difference between savings and investing, it's two things. Savings is short-term. That's the first major distinction. So I would say that savings is anything that's less than 2 years. So any money that you're putting away that you know that, okay, in 2 years I'm calling on this money, it's savings. And when you are saving, ideally you should be trying to be on pace with inflation. And essentially what that means is, you guys, do you remember how much things cost 3 years ago and how much they cost now? You want to be able to put your money somewhere where you're keeping, your money is keeping track with the prices. So that's savings. Investing is long-term. So that's any money that you know that you can put away and you don't need to touch for the next 2 or so years. And that money should be beating inflation. So it should be giving you higher returns than inflation. Okay, what's the last thing? Budgeting.
Yeah, how can young people more realistically actually stick to
a budget? Okay, I love this question so much because I'm sure everybody here has tried to budget before. You've heard that you should have a budget. Budgeting has bad PR. People hate budgeting. The reason why your budget doesn't work is because it's not data-driven. Guys, I'm a science student. If you want to create a budget you can stick to, this is what you need to do. Go into your bank app, download your 3-month statements, open ChatGPT or Claude, ask it to show you what you actually spend money on, not what you think you spend money on, because I'm sure if I ask you guys how much you spend on eating out, you guys will say 50K. By the time we check, you'll be like 350K. So go and ask AI to show you what you're actually spending money on. Now, when you have that data, from there, you can now extrapolate that, okay, clearly, I don't think I can spend less than 50K on transport a month. even though in your heart you feel like you should be spending 25K, but the data are showing you that it's not possible. So make sure that you're building your budgets from your actual patterns and behaviors, because you'll be more likely to stick to them. And make sure it's based on your principles and your values. So for example, for me, Ibi Ibru, I would rather do my hair than go out to eat. That is what I care about. So that is where I direct my money to. Your budget should be based on your values, not what you think that you should be spending money on. Do you understand? So don't be like, I think I spent too much money on going to the gym. Maybe I should spend more money on something else. And then month after month after month, you don't make it. That's because it's not aligned with your values. It's your money. You should be able to spend this responsibly, but aligned in your values. So look at the data. Decide what you care about spending money on and budgets for that. So like I said, if I've decided that I'm coming to Africa everywhere and I want my hair to look a certain way, and my friends have asked me to come out 3 times this week, I will say no, I'll go out once because I know I want to go and do my hair for this. That is what I care about spending my money on. Do you understand? Exactly.
No, thank you so much. That was amazing. So a round of applause. Yeah. And Ms. Onyinye, do you have anything to add?
Okay, so the difference between savings and investments, like Ibi rightly said, short-term, long-term. And as we go into the workforce, let's remember this. Whatever we earn as a salary is our savings. So your savings should be deployed towards a sinking fund, an emergency fund, something that is liquid enough for you to dip into and solve an immediate need, right? And your investment is what you take from your savings and plug into a meaningful and purposeful vehicle, right, to secure your future. So those are the 2 major differences for me, all right? So savings is what you're earning, and investments is what will propel you and secure your future financially. And it is definitely long-term. You have to have a long-term horizon when you're thinking about an investment. In terms of budgeting, to add to what Ibi has said, so as we move into the labor force, the workforce, let's also remember that budgeting is so important. At the start of the year, you have to think about what your income is. What are you earning? What comes to you? And most importantly, you have to save before any other thing. So don't spend on, perhaps electricity bills, black tax even, and then at the end of the month, you now save what is left. It's not going to work, all right? So in budgeting, you have to consider how much comes to you, how much you want to save, and then you also have to determine your expenses. So we have expenses, fixed expenses, and these are costs to us that don't really change. So for instance, for those that pay rent, that's a fixed cost. Maybe you have an insurance premium, maybe on your car, or even for those that maybe have children, in a school year, school fees could be a fixed cost. So you have to back that out. And then now look at your variable costs. Because in school, I know we had your variable expenses. In school, we had fixed costs and variable costs. So that in budgeting, we're going to have fixed expenses and variable expenses. So with your variable expenses, you're looking at payments that you make maybe for groceries, skincare, just general expenses that are not entirely fixed and that can be modified. Because with sometimes the way inflation is going, you really just have to sit down, track your expenses, and look at what really is the most important to you. Ibi said if she needs to make her hair, she's going to have to forfeit 3 outings with her friends, and that's her priority. So the same thing applies with your variable costs, okay? So put that into perspective. Figure out your fixed expenses and your variable expenses when you're creating your budget. And by all means, please track your expenses weekly. Print out your statements and track it weekly. Don't wait till the end of the month, because you have to remain tactile in this environment, okay? So you have to be able to adjust and, be agile and just switch things up so that your money makes sense for you. And first things first, pay yourself first. So at the top of your budgeting is your investment amount. What am I taking out to keep for myself? And then every other thing falls into place. Thank you.
Thank you so much for that, Ms. Onyinye. And thanks for talking about the importance of budgeting, as both our panelists have spoken on now. I'll wrap up this session soon, but I'd like to wrap it up by asking each of you a final question. But before that, I'd like to ask Mrs. Oghogho. A lot of our audience here, I'm sure, will be receiving the first salaries or first few salaries as they'd be going on to carry out their internships. And so how would you advise that someone should manage their first salary, especially as an intern?
So thank you very much for that question. I want to start by making a comment about the issue of savings. Beyond what they've said, very quickly, savings is setting aside something from what you earn in order to be able to invest it. Because sometimes you have to, first of all, save for some time before you have enough that you can now plow into investment. Now, when it comes to your first salary as an intern, I'm going to answer in two ways. One, me, Oghogho, as a Christian, and then what I would advise you if you were not a Christian and you're thinking about trying to be financially literate. So, as a Christian and as Oghogho, my first salary was given to my parents so that they would bless me. That's what I did. But when you're looking at financial intelligence and financial planning, you should budget your salary such that you don't spend 100% of what you earned. So there are various principles that you could apply. There is a 70-30, there's an 80, there's a 70, 10, 10, 10, you know. There's a 50, 30, 20. So let me just explain the 50. 50% of what you earn should be put to meet your needs. But then what are your needs? The needs vary depending on your level. You know, what you need as somebody that has just started working is different from what you need when you are going up, because there's the lifestyle inflation that comes up and all of that. So your needs, 50%. Your wants and any other thing, 30%. And the rest, 20%, save it and then invest it. That's one principle. Another one, 70% should be for your needs, 10% to God, because there's the tithing for the Christians. And then the other 20% to take care of anything else, charity and whatever else. But one thing I can tell you for sure, don't spend all you earn. Don't wait till you earn enough. The thing about human needs is that human needs are actually not satisfiable. I'm sure you've all heard of Maslow's hierarchy of needs. Human needs are never fully satisfied. So just make sure that you budget yourself such that your first salary, make sure you don't spend everything that you earn. You keep enough, you know. I mean, you keep a percentage of it, no matter how small you earn. It's just a habit that you want to form so that you ensure that going forward, when you start earning big, you still keep a proportion. Thank you.
Yeah, thank you so much, Miss. Thank you so much. And just our final question, and I'd like you to please, for time's sake, just answer in one line. What does financial freedom mean to you? We can start with Ibi, or we can start with someone else. Yeah, if you can. What does financial freedom mean to you?
Financial freedom means to me not being tied to a job, a person, or geography for income, a singular job, person, or geography for income. So no matter where I am or what I'm doing, or I don't know who I'm with, that I always have finances.
Okay, thank you. Next.
All right, so financial freedom for me, it's not about opulence or being so wealthy that you can afford everything. It's just about having less financial anxiety. You can afford your needs. You can afford to repair your car if it needs to be repaired. You're not put under pressure. So that's financial freedom to me.
Thank you.
Financial freedom to me means being able to live your lifestyle without having to worry about where the next paycheck is going to come from. Having enough investment such that if you didn't work for the next 5 years, you'll be fine, because what you've invested can meet your needs.
Thank you all so much for this amazing panel. Can we please give them a round of applause?